issue. Okay, so this is the third class. November we have 4 weeks, so it's a 7. So when is your midterm break?
Week 6, doctor.
Huh? Week 6? So on
Sorry.
somewhere
After week 6.
after week 6, so 23rd until 29th of November, that's week is your break. Your break, kuliah. When is your break? Cuti pertengahan. Is it you? Oh no. What is the exact date?
Mm.
24th November until 30th of November, right? So next we're gonna have 3 class, 24th until 30th. Okay. So week after week 6. Oh, someone have to remind me. So and then we have class December. Okay, December we should have class after you come back from the midterm break. So we already enter December. So December 3rd, 10, 17, 24th, 31st. So 6 plus 5, 11 weeks. Okay. So 11 weeks. So again, okay, our class on Wednesday, okay, on Thursday 25th Thursday, and then the New Year also Thursday. Okay. So is it you guys having an online class on that 2 weeks, 24th and 31st of December? Okay, so Adika Raditya say think so. Okay, so why we have only 19 members? We should have 31 members. Why? Okay, I have shared with you the attendant links. Okay, so for these purposes, okay, can you provide me your digital sign? Can you open the attendance, okay, and then provide me your name, your metric number, and your digital sign? This also give kind of reminder to the rest of the members to join our session, because the attendance so far, the members that joined us so far is 20. So 11 members still missing. How many of you cannot have the access to the attendance? Why you have no access? The rest already starting fill out the attendance. Please provide me your digital sign. Okay. Yes, Jia Ho Zhao.
Oh, hey, doctor.
Yes.
I have a question about the TikTok video.
Okay. What is the
So should we just record face or we use some slides?
um anything as long as it is attractive and catchy.
Okay. So and also I have another question. Like, should we put our name and your name on the slides?
No,
Okay. Understand. Thank you, doctor.
don't mention my name, your name, the institution name, the course name. No.
Okay, understand. And also like, how can we submit the video because I didn't see where to submit.
You don't see where to submit. Okay, good question. Okay, so the way you submit is that all groups, okay, will send it to Uzen. Okay, Uzen will create one link of Google Drive. Okay, which it will be sent or share with me.
Understand. Thank you, doctor.
Okay, Uzen, is it okay, Uzen?
Yeah, yeah. But create link how? How to how to create
Uh,
the
it's not necessary to create a link. You know, when
yeah.
the video, the size of video is big enough, it will directly convert to Google Drive.
Oh, okay. So I compile everything and then
And
I
then
send
forward
to
to
you
me.
lah.
Yeah. It's just like,
Okay.
you know, you make an attachment, okay, everyone send to you. I'm not so sure how they're going to send to you, okay?
Okay.
Once it's just like you attach a document to your email, for example. So when you keep on attaching, when it is big enough, it will directly convert to the Google Drive and then you send to me.
Okay. But why not we just send to you in the class on next week?
How? You're going to send me the video?
Yeah, yeah. Email you the video because we're going to meet next week, right? It's a physical.
Yeah,
Ah,
but that is video.
yeah,
So it must be through email.
yeah, yeah. I'm also not sure lah.
I think we agree that you guys must publish the video, right, in your TikTok, right, in one of the members TikToks, right?
Yeah,
So
yeah.
basically you just share the link to you, and every groups share the links to you. You just
Okay, okay. And then
link
I
and
what
forward
like
to me.
satu.
It's
Can,
not
can, can.
video. It's
Okay,
just a link.
okay, okay.
Uh,
Can,
that that that's better rather than submit the video to me.
can. So the deadline is before the class lah, before the 12 p.m. class lah, or during the class.
We have you have record everything, right?
Yeah, yeah.
Assignment one due 5 November before class. Before
Before class,
class.
before class. Okay, okay.
Hello, doctor.
Yes.
Could you provide us course information and references so we can know like when is our midterm and how many marks for CA, a group assignment?
Oh, we have discussed it in our first session.
Uh, yes, but like I forgot it.
You forgot it or you are not attending? You are not
No.
attend.
Did you? Yeah, I went there, but like I forgot when is our midterm
Mhm.
and may I know which week?
Not so sure yet.
Oh, not yet.
I will let you know 1 week before.
1 week before the midterm.
Yeah.
Oh, okay, I got it.
Okay, 1 week before. Is it good enough? 1 week before?
I don't think so. Maybe 2 weeks before or 3 weeks before?
Hmm. I cannot promise you. What I can promise you a week before. Okay, I try my best to give you more time. Okay,
Yeah, okay, thank you.
I will try. Okay, because this is my first time, so I need to organize. Okay, uh,
Okay. Thank you, doctor.
okay, because if I can, because the ones that I discussed with your head department is that the
Yes.
midterm is going to be 30%, the assignment will be 20%, the final will be 50%.
Yes. Yeah, I know this. But like, yeah.
So your concern is more on when is the midterms, okay?
Yes.
And then the second concern is what cover for the midterms, right?
Yes.
Okay, so usually what I used to do is that if the course have only midterm, so it's going to be like week 8, week 9, okay? Because there's no first test, second test. Okay,
Yes.
if the course have first test, second test, so the first test will be around week 5 or week 6. Okay, that
Oh,
is what I used to do. Okay, if midterm, so basically after week 7, basically. Okay, but since you guys having a midterm break after week 6, and then
yes.
you come back on week 7, so I don't think so it is good to have exam a week after the midterm break, and then meanings that during your break you are not free, you're not happy, you have to do your revision. Okay,
Yes.
that is not in a favor of being a student. Okay, so at least week 7, you first week after the break, maybe week 8 or week 9 is just nice. Okay, you are already warming up yourself after a break.
Yeah, I think so. I agree with you. Yes. I hope we get one week nine.
Hopefully,
Yeah.
during the break, okay, give me ample of times to organize, and I will make announcement through Uzen if I'm ready. Maybe Uzen can just send me a reminder. So if I'm ready, I will supply the information.
Okay, I got this. Thank you, doctor.
Okay, welcome. Uzen, there is a message for you, Uzen, about how to share the TikTok link with me by creating Google Docs, okay, Google Word. Okay, we still only 22. Another 9 members still missing. Why the we don't have a full members? Huh? What happened to the rest? What are they doing?
Not sure, not sure.
Not sure. Hi, Hairato Munihito. Are you?
Yes, yes. Oh, yeah.
Please come with your digital sign.
Yes, I did.
Okay. And then Muhammad Safwan.
Yes, doktor.
Digital sign, digital sign.
Tengah sign kejap doktor.
Tengah buat. Okey, semua tengah buat. Okey. And also Ellie Tan Jia Yong, okay, your digital sign. Don't give me a very big digital sign, okay? Okay lah, you can give big or small, I will adjust it, okay? Okay, while we are hopefully more member will join the session, okay, because the attendance at this point of time is still not good. I mean Sofian. Why I mean Sofian? Where's I mean Sofian? It's already done, okay. Okay guys, so let us continue our discussion. Okay, so where do we stop? Is it here? We already formed these equations, right? Or not? Or we are here? The changes of the curve, money demand curve and supply curve. Anyone? No one remember?
I believe we stopped somewhere like slide 24, maybe. Yeah, here. Or 25.
Okay, 24. Okay, so we have discussed the movement along the money demand curve. Okay, the shift of this money demand curve, right? So okay, the 25th, 26, 28, and 29. Okay, these are those explanation. Okay, the income effect. Okay, shift of demand for money demand curve. Okay, income effect, price effect. Okay, and for the shift of the supply is coming from the central bank. Okay, Federal Reserve. And this slide is just a summary. Okay, of those factors that lead to the shift of this money demand curve and money supply curve. Okay, we have discussed all this, okay, by using this slide, right? Okay, so we know that the money demand is actually instead regardless of whether the money demand is influenced by interest rate, by income, by price. Okay, these are the three traditional factors that may influence money demands. Okay, instead of whether it is movement along the the curve or it is a shift of the money demand curve. These are the three variables, okay, three factors that influence money demands. Okay, so we can also reorganize, okay, the factors that influence money demand into an equation or into an equation. Okay, so we have over here what is money demand. Okay, money demand is equal price. Okay, price. Okay, this is a times L here. Over here is the function. Okay, it's just like this function is just like um, we have a production function. Okay, production function is y equal to a is a functions of k l. Okay, so this is production function, and here we have a money demand function. Okay, so we have a over here. Okay, so here we have price, and this a symbol like a f. Small case of f is a function, and this l is also a function. Okay, functions to income, okay, and interest rate. Okay, so as we discussed earlier, okay, incomes, once we have more incomes, okay, we will tend to spend, and once we tend to spend meanings that we going to demand more money, okay, than income. Price, we have also discussed that the higher the price, the more the money that we need in order to pay the price. Okay, so if the price increased by 10%, so we need exactly an additional of 10% of money in order to buy that goods. Okay, but for income, if the income increase 10%, okay, generally through a rational process, okay, if our income increase by 10%, basically we are going to spend about plus minus 70%, okay, and the rest of 30% will be kept as a saving. Okay, so that's why if the price increase, okay, so it is a proportional uh, increase with the money, while income it is not. Okay, so that's why in our I think we have discussed also about the elasticity. Okay, the elasticity of these changes in terms of price, income, and interest rate. Okay, interest rate, yeah, we have a negative relationship. Okay, we have negative relationship. The higher the interest rate, money, the lower the money demand. Okay, so basically based on this equation, okay, we can also put the we call it as a kind of relationship that exists, okay, between these factors with money demand. Price is a positive, okay, income is a positive, interest rate is a negative. Okay, so basically we call it as a what it's a the higher the price, the higher the money demand. Okay, so it shows that a positive relationship. Okay, sometimes, okay, we also call that this sign, okay, as the expected sign. Okay, expected signs. Okay, what is the expected signs of price on money demand? So it's a positive sign. Okay, so this is from the theoretical framework. Okay, if you read any article journals, okay, when the people run the analysis and they have the result, okay, based on these theoretical science, so it's a bit easier to justify, okay, about the result. Okay, but however, it's not necessary that all analysis will lead us to the same expected sign. Okay, sometimes we have a contradict result, okay, where we need to have to justify, okay, to justify it why. Okay, sometimes it can be justified from the economic phenomena. Okay, sometimes from the nature of the country. So why we have a kind of contradict result or signs. So this is the money demand equations or money demand function. Okay, so next, next is what we want to do is that uh, we replace the nominal interest rate, okay, with a real interest rate and the expected inflation. Okay, so we replace over here with this. Okay, so meanings that we are converting basically, okay, the nominal interest rate into a real interest rate. Okay, so the basic idea in any economic indicators, okay, we can define it as a real term or nominal term. Okay, so in order to convert from the nominal, okay, into real, okay, into real term. Okay, so the activity is to offset, okay, the price effect. Okay, we need to offset the price effect. So if you look at the GDP, okay, we have nominal GDP, we have real GDP, right? So in order to convert from nominal to real GDP, okay, so usually when we say GDP without mentioning the real, the terms real, the words real, okay, basically we are referring and it is actually reflecting the nominal GDP. While when we are talking about real terms indicator, we will spell out real exchange rate, a real GDP, real interest rate. Okay, we will mention the word real. Okay, so in order to calculate the real GDP, we offset the price effect. Okay, so basically into a layman word, meaning that we pull out, okay, we exclude the price effect. Okay, so what we did in order to calculate the GDP is we using a constant price. Okay, while the quantity and volume produced in this year, okay, the current year, okay, uh, will be times by using the current price. So current price is basically the base price, okay, the base price, okay. Usually if you look at the trend, okay, the base price, okay, is basically they are selecting the base price, okay, based on 5 years time, okay. So nowadays, if I'm not mistaken, okay, I cannot remember whether it is still 2010, okay, the price of 2010, or they have changed, okay. So there we select, okay, any years, okay, any years that actually show or act, okay, the less fluctuations of the price, okay, the most stable year, okay, the most stable price for that year, okay, so will be selected as a base price. Okay, so means that if we want to calculate the real GDP for the current year, we will use the base year price. Okay, we use the same price, okay, but the quantity or the output produced is different, okay, from the previous year to this year or the current year. Okay, so for the interest rate, okay, for the interest rate, the concept is still the same, that we're gonna offset the price effect. Okay, but over here we don't directly actually use price. Okay, instead we use inflation. Okay, we use inflation, we use expected inflation. Okay, if we can rearrange, okay, this equation, okay, so basically real interest rate is equal, okay, the expected inflation, okay, minus nominal interest rate. Okay, sorry. Okay, okay, the nominal interest rate, we offset the price effect. Okay, so we pull out the price effect from the nominal interest rate in order to give us the real interest rate. Why we need to do this? Okay, because we want to convert, okay, we want to convert our money demand function into a real money demand function. Okay, we want to convert our money demand function now, okay, into a real money demand function. Okay, so by replacing the interest rate, we got this equation. Okay, and then we want to convert the money demand function into a real. Okay, so again, the price play the important role where we need to offset the price effect. Okay, so over here, okay, uh, we use that money demand divided by price. Okay, equal y r plus expected inflation. Okay, so we divide both side by price. So we're gonna cancel this. So this gives us this third equation. Okay, so the third equation is now that actually converting, okay, converting the money demand function into a real money demand function. Okay, so next, okay, from this equation, okay, we set, okay, this equation into a equilibrium condition. Okay, we set this equation into equilibrium condition. So equilibrium condition, okay, this must be equilibrium condition must be supply equal demand, right? So based on this equation, it gives us money supply equal money demand. Okay, money supply equal money demand. So based on the this equation, okay, we say that real money demand, okay, real money demand equal this. Okay, so we know that these are the uh, factor, okay, that influence money demand. Okay, so the right hand side, okay, will act as a money demand. Okay, and on the left hand side, okay, over here will act as a real money supply. Okay, it will act as a real money.
Doktor,
Yes.
doktor can record this lecture.
Yep.
Boleh record lecture ni.
Record.
Mm-mm.
Nak record. Record ni nak buat apa?
Kalau macam my line was not that good, so like if I miss something, so it's like
Tak clear lah. Apa dia?
my line was not that good, so if anything I missed, so I can watch it again.
Tak clear. I can hear that you say that your line is not clear.
Sorry.
But unfortunately, I never practice supplying my record. Okay. I never surrender my record, okay, to any students, okay. So you need to be okay at the point where you can have best access to the internet. Even though recording, okay, is just for my own internal purposes, okay. But for the case here, I cannot see how I'm able to record, okay, because I cannot see the here is only timer. I'm not so sure, is it a timer countdown in the call? I'm not so sure.
It's okay.
Okay.
Um, Professor,
Yes.
where can we get the lectures like?
Where? Uzen, you don't share, Uzen.
You didn't share.
In the WhatsApp group, okay. In the WhatsApp group, okay. Tak dapat lagi slide Nurin tadi.
Ya, tak dapat lagi sebab baru masuk.
Ang baru masuk, kalau if you just join the WhatsApp group, if I'm not mistaken, you cannot go for the past conversation, right? So someone need to post it again. I'm not so sure whether the WhatsApp group you have any kind of a new icon you can allocate all this into one files or one folder and then share. I'm not so sure. Maybe Uzen will create one Google Drive link and put all the notes and then just pass around the link. Okay, so anyone will always come and pick up if they miss anything. So everyone is accessible to that link. So any miss kind of documentations, okay, so they can help themselves. Okay. Okay, let's go back to the business. Okay. Okay, so on the left hand side, okay, we'll be converting into a money supply. Okay, so this will be this in the form of real, okay, real. Okay, but since we put it under a equilibrium condition, so we need to have supply and demand. So the right hand side, okay, will be act as a money demand, and on the left hand side will be actually act as a money supply. So here is the equilibrium of this money market. Okay, so from this money market equilibrium, okay, we can also uh, rearrange, okay, and solve for price. Okay, rearrange and solve for price. So rearrange and solve for the price. Okay, P will be Okay, we can rearrange equation 1 into equation 2 and solve for the price. Okay, so once we do this, okay, so we are actually converting, okay, from the uh, money equation, okay, into a price equation. Okay, this equation 2 allow us to determine price. Okay, so what actually influence price? Okay, so by defining this equation 2, okay, so M over here is money supply over, okay, over money demand. Okay, so basically the price, okay, is the ratio, okay, is the ratio between money supply and money demand. Okay, so this shows how close, okay, how close is the relationship between price and money. Okay, it is also stated over here is that doubling the money supply, okay, will double the price. Okay, meanings that money demand remain unchanged. Okay, if money supply increase by 10%, okay, increase by 10%, okay, the price also will increase exactly 10%. Okay, any changes on our right hand side actually will be reflected on our left hand side. Okay, is it clear?
Clear the.
Okay, thank you. So next is by using equation 2 over here, we put the equation into the growth rate, okay, into the growth rate, or by taking the changes, okay, by taking the changes. So changes of price equal to the changes of money supply to the changes of money demand. Okay, uh, the purpose, okay, to convert, okay, the equation into the changes, okay, changes, okay, which allow us, okay, to reflect, okay, the rate of inflation, okay, changes of price. Okay, changes of price is actually defining by the growth rate, okay, the changes of money supply to the changes of money demand. Okay, so uh, it's a it's a it's a something fundamental that changes in money supply, okay, basically will be reflected into the price. Okay, that's why as our first assignment, increase in money minimum wage, okay, will also increase the price. Okay, so we inject more money, okay, into the economic circulation. So the expected inflation, okay, over here will be equal to the current inflation if we have a stable, okay, stable money and income over here. Money, we have stable money and income, okay. So the expected, okay, why do we use expected inflation? Because it's not easy to observe inflation. Okay, so that's why we use expected inflation. Okay, so next, okay, uh, based on the growth terms equation, okay, we have a few assumptions over here. Okay, the first assumption is that the I is constant. Okay, I is constant. The nominal I is constant, so means that we can cancel out this term. And in the same times, we also replace the changes of price into inflation. Okay, so we have this inflation and we have these equations of money demand. Okay, and then the growth rate of real money demand, okay, is equal. Okay, so this is the elasticity. Okay, the elasticity of income, elasticity of money demand. Okay, it's a changes of quantity of money, right? Quantity of money over changes of income, right, is equal to elasticity, right? Elasticity of money demand. Okay, so if you can rearrange, okay, this equation, okay, if you can rearrange this equation, Okay, so this allow us to have uh, elasticity of money demand. Okay, the changes of y equal to changes of q m over q m. Okay, if you bring this equation on the right hand side, so it will give us this negative sign. Okay, so from here, okay, so we bring the elasticity element, in this demand money demand functions, but here we have defined that the inflation, okay, is the changes of money supply and this money demand, okay, real money demand. But it is now we bring the element of elasticity. Okay, so that's why we have been talking about the elasticity. Okay, the price, if the price increase by 10%, we need an additional of 10% of money in order to buy goods and services. So meanings that uh, for the price, okay, the percentage change of price, okay, is equal to the percentage change of money. So the percentage change, the percentage change, the percentage change. Okay, the percentage change of price is equal to the percentage change in money. So this elasticity is unit elasticity. And then for the interest rate and income, okay, the percentage change, okay, for income and the percentage change in money, okay. If the income increase by 10%, okay, the money demand will change about 70%. So the change of income is greater than the change in money demand. Okay, so basically we having a inelasticity. Okay, for interest rate, okay, the percentage change of interest rate, and then the percentage change of money. Okay, so if the interest rate increase, okay, if the interest rate increase, so basically we tend to demand less money, okay, because we tend to save our money, okay, because we want to earn the return, okay. The higher the interest rate, the better the return, okay. We want to earn the return, okay, and basically allow us to consume more in the future. Because interest rate is basically paid uh, towards the end of financial statement, okay. Usually it's the end of the year or 1 year fiscal cycle, okay. So meanings that we're gonna spend more in the future but spend less at this point of time or in this current time, okay. So over here interest rate if increase 10%, we are not going to put all the money, okay, into the bank in order to earn the profit or the return, okay. So it is also, okay, less, okay. The interest rate is greater, the changes in money demand going to be less, okay. So but the changes, okay, the elasticity is negative. Okay, if you still remember one of the benefit of using this elasticity measurement, okay, so we don't take into account, okay, the negative or positive signs, okay. We want to know more on how this quantity react, okay, due to the changes of price, or in this case due to the changes of income, interest rate, okay, regardless of what is the sign. Okay, so basically, okay, so the money demand functions that we have over here is the final output of money demand functions, okay, that has been carried out by uh, uh, many economists, okay, starting from Fisher, okay, Fisher, Keynes, Friedman's, okay. So if you go to the higher level, okay, so we discuss, okay, how do they are actually form this money demand function, okay, from the initial idea, okay, and then until they form these functions. So it is started by the Fisher, okay, in 1911, okay. They try to link, okay, to discuss, okay, what are the kind of relationships that actually uh, exist, okay, between money and the amount of spending. Okay, so Y is standard notations that reflect output, income, GDP, okay, and then times price. Okay, so meaning that over here Y now is acting as a quantity of output. Okay, and then we have price. So price quantity of output, price times output. So meaning that that's going to be a total spending. Okay, total spending. So since the price is there, so P times Y is a spending, nominal spending. Okay, the value of the spending. So how do we connect, okay, between M, money, and this nominal spending? So they believe that, okay, one of it is the velocity. Okay, the velocity of money provides the links between money and nominal spending. So what is the velocity? Okay, velocity is how many times, okay, that money is used, okay, is used or is consumed. How many times that money is used to spend? Okay, how many times that money is used to spend? So we divide, okay, the nominal spending with money. Okay, nominal spending with money. So that gives us the velocity. Okay, how many times that money is used, okay, to buy goods and services. Okay, for instance, GDP in a year is 10 trillion. Okay, GDP is 10 trillion. GDP, okay, it's not real GDP, okay, GDP. And the quantity of money is 2 trillion. Okay, quantity of money is 2 trillion. So GDP, okay, the GDP is 10 trillion. Okay, and the quantity of money is 2 trillion. So this money, 2 trillion, okay, has been used, okay, 5 times in order to buy good and services, okay, for this particular point of time. Okay, it must have time periods, okay, otherwise we can use so many times of money, okay, in order to do our spending. Okay, so the last part, okay, is those factors, okay, that going to make up, okay, make up our mind whether we gonna hold money or non-monetary asset. Okay, so basically we have a trade-off. Okay, how much money or how much non-monetary assets that we going to hold. Okay, we have return. Okay, we have expected return, we have risk, we have liquidity, and times to maturity. Okay, so if you have a lot of money, okay, you can convert some of those money that you are not going to use in a short term. Okay, you can convert it into a non-monetary asset that may give you high return. Okay, usually high return, it comes with the package of uh, high return, it comes with high risk. uh, it's not easy to liquidate, and the time to maturity is very long. Okay, so that's why for those who want to earn a better profit, a better return, okay, we have to park our money, okay, for some times. Okay, if we don't have enough money, okay, so we have to do a very wise decision. Okay, how much return that we going to earn, how much risk that we going to take, and how fast the asset going to be liquidate. Okay, and the times to maturity. Okay, if you have a lot of money, okay, you can take a very high risk. Okay, some of these non-monetary asset, okay, stock and bond, okay, they are not even capital protected. Okay, but the return is very high. Okay, and risk also very high. The greater the risk, the greater the returns. Okay, so if your capital is not protected, means that if you want to make any kind of investment, okay, buying a stock, okay, for 5,000, okay, so any failure, okay, any failure, if the firms, okay, announce that they are bankrupts, okay, so you will lose even your 5,000, 5K of your investment if they are not capital protected. Okay, if they are capital protected, if the bank or if the firms declare bankrupts, okay, you can still have back your 5,000. Okay, if not, if the capital is not protected, uh, you will not have any single cent. Okay, not to mention about your return, but your capital. Okay, the cost that you use to make the investment also will be disappear. Okay, so one asset, okay, uh, based on Malaysia case, okay, one asset, okay, the return is not really high. I would say that the return, the purpose of this product, okay, this product is actually designed, okay, previously or in the first place, okay, it is slightly I would say it is higher, double, okay, but today it is slightly lower or equalized. Okay, it becomes the equalizer, okay, for the inflation rate. Okay, so it is a low risk, or I would say that there is no risk. Okay, low risk or no risk. Okay, and then it is also, I would say, very fast to liquidate. Okay, very fast to liquidate, and it has no time to maturity. Okay, so if you invest in that kind of a product, okay, you will not going to lose your money. Okay, your money will be there. There's meaning that the risk is I would say no risk. Liquidate, you can always convert it back into cash. Okay, very easy. You can go to any banks and withdraw. Okay, there is no kind of fixed dates or how long that you need to save the money, okay, before you can withdraw. Okay, and then the time of maturity, there's no time of maturity. If today you're going to buy the stock or non-monetary asset, and tomorrow you decided to have your cash, you can always go to the bank and withdraw your money. Okay, so that product is, maybe some of you are familiar, okay, it's a ESB. Okay, ESB. Okay, some may say that the ESB is a saving account. Okay, so basically ESB is not a saving account. Okay, it is a unit trust. Okay, unit trust. If you are actually deposit your money, okay, 1 ringgit into this unit trust, okay, into this ESB, okay, so meaning that you are buying a 1 unit, a 1 unit trust, okay, uh, from this ASB, okay, 1 unit. So 1 ringgit equal to 1 unit. Okay, so if you are investing 10,000, you are supposedly the holder of 10,000 units of ASB product. Okay, so this product allow you to withdraw at any times. Okay, meanings that it's not to mention the public holiday. Public holiday, of course, no one can do transaction. Okay, so you can withdraw anytime. There's no fixed time periods that you need to hold the money. Okay, and then the return. Okay, the return nowadays is not attractive enough, especially after the COVID-19. Okay, but I would say that it is more or less, okay, good enough to equalize the effect of inflation. Okay, so at least you got some returns, okay, because you have some excess of money. So you keep your money in this unit trust, okay. uh, at least uh, you can preserve, okay, you can preserve the the value of money, meanings that you can meanings that your purchasing power will be remain intact. Okay, so you're gonna have some amount of extra money towards the end of the return. Okay, so at least you are not affected by the inflation rate. Okay, but nowadays the return is I believe that because the inflation rate in Malaysia is calculated based on the what we call it under control items. Okay, it is calculated based on the price of control item. Okay, so that's why the rate of inflation in Malaysia is is maintained. Okay, maintained very low. Okay, but actually people are suffer. Okay, people are suffer. So the item under control is basically very necessity items. Okay, so of course the price is controlled by the governments. Okay, so it is reflected in our inflations. Okay, but exactly basically it is not reflected. Okay, many things it is not in the in that basket of goods. Okay, the basket of goods that we use to calculate the inflation, because majority most of the goods is actually coming from the control item. Okay, another product, okay, another good product prospect. If you have money, okay, you can invest in bank rakyat. Okay, bank rakyat, bank rakyat, bank rakyat. Okay, there is a one uh, investment in bank rakyat that actually offer 15% of return. Okay, 15, but the ASB is just like maybe I can't remember nowadays. Okay, because nowadays I'm not interested anymore with the ASB. Okay, because the view, okay, is kind of conflicting between conventional and Islamic compliance. Okay, I think it's about I can remember 3 or 4%, but the Bank Rakyat offer you up to 15%, and it has been like maintaining 13 to 15% of return, okay, for about 20 years, okay, 20 years, okay. But they have closed that product, okay. They have closed for new investor, okay, for those who have invest it, okay. I think it started they're going to, when they're offering that, actually they are actually collecting or fundraising for the capital, okay, to make in huge investment. It's somewhere 2004, okay. For those who have invested in that product, it will be enjoy about 15% of return, okay. That 15% of return, but the capital that you invest is not protected, okay. So it is in line with this factor, okay. The higher the return, the greater the risk, okay. So the capital is not protected. If Bank Rakyat declare bankrupt, so you're gonna lose your capital, okay. If you invest 5,000, so say bye bye to your 5,000. So that's why in this asset world, diversification, okay, is very important. How you allocate your asset, and these are the four factors that may leads you to make up your mind, okay, how much that you keep as a money, and how much of your money that you can convert it into a non-monetary asset, including, okay, including buying house, land, okay, those who have steadily increasing trend in terms of their price, the value of the price. Okay, guys, anything, any question?
No questions, doctor.
No question. Okay. um, Okay, only 24. 24 attendance, okay? Any one of you still not fill out the attendance? Maybe we take maybe 5 to 10 minutes, okay, and one, and then we continue somewhere around 2. We continue a bit before we end our session. Is it okay?
Okay, okay, doktor.
Hello, doctor.
Yes.
Oi, Munir. Oi, Goi.
Safwan ke tu?
Yes.
Just, doctor, just nak tanya. Ni, untuk kelas ni kita ada attendance ke yang kena sign digitally ke apa?
Ada tadi, I dah share the link.
Oh, dekat chat eh?
Dia
Oh,
exactly for like me. I'm a part timer. Okay, so it's strongly, okay, strictly and strongly they want attendance. Okay, so that's why when all of you requesting online session, okay, so because I'm being informed to have a physical attendance, okay, so that's why I'm requesting a digital sign, okay. That is the best I can send them the proof that we're having a class. So maybe I can forward you the link again.
okay, sure. Thank you. Thank you, doctor.
Okay, for those who just join our session, okay, maybe you miss or you just join. So here is the attendance link, okay, in our message, okay. Okay, let us discuss a bit on this topic. Okay, and then we can end the session. Okay. Okay, so can we start? Yes, Amirul.
Yes, betul. Can start.
Okay, thank you. Okay, so in this monetary system, okay, so basically we have three player. Okay, it start with the central bank, the monetary authorities. Okay, and then the banking sector and the depositors. Okay, the depositor basically reflecting the user. Okay, so three. Okay, so the ones that we're going to discuss now, it's coming from the second player. Okay, the banking sector. So what we're going to discuss, we're going to discuss how uh, the transaction, okay, the transaction or the business, okay, to record the transaction, okay, to record the transaction of this banking sector. Okay, so when we want to record the transaction of this banking sector, so basically we try to understand the flow of business, okay, for this banking sector. So in order to understand it, okay, we will explore, okay, the balance sheet of this banking sector. So balance sheet, okay, is just like a T account. Okay, so we have asset and liabilities, and also we have capital. Okay, so through this T account, okay, we need a balance, okay, between asset and liabilities. So we need a capital, okay, because a capital reflects, okay, how stable is the banking sector, the banks. Okay, it also reflects how uh, the the bank are ready to face any economic crisis. Okay, so the bigger the capital of the bank, so means that the bank is basically more stable, okay, more vibrant. Okay, so this is the balance sheet, okay, example of balance sheet of commercial bank, okay, when we talk about banking sector. So basically, in general, it's reflect the commercial bank. So in Malaysia, okay, a few of the commercial banks, okay, in Malaysia, okay, is a CIMB. We have Melayan Banking Berhad, RHB Banks, okay. So this is just like a T account. Okay, we have the asset on our left hand side, and we have liabilities on our right hand side. Okay, so on the left hand side, okay, consider as an asset for the bank is the reserve. Okay, reserve securities. Okay, securities when the banking sector buying securities, when they're making loan, okay, they're giving loan, okay, they lend out loan, okay, so it's also asset for them. And also other asset, okay, physical capital asset owned by the banks. So liabilities, okay, what are their liabilities is deposit, okay, their deposit, okay, all those sorts of deposit, checkable, non-transaction deposit, okay, deposit, and then borrowing, okay, they lend out loan, they also make borrowing, okay. So when we don't have money, we borrow from friends, family, we borrow from financial institution including banks, okay. When the banking sector they don't have money, okay, they are also borrow, okay, they borrow money, so they borrow from their friends of banks, okay, or from the central bank. Okay, so let see. Okay, the first items, okay, for the asset is reserve. Okay, reserve, required reserve. I believe that we have familiar with this required reserve. Okay, required reserve ratio. Okay, this is mandatory. Okay, mandatory by the central bank. Okay, it's a percentage of deposit received by the banking sectors that needs to be deposited into the central banks. Okay, so this also as a precautionary action. Okay, where if the required reserve ratio is 10%, so meanings that if you deposit 100 bucks, okay, 10%. Okay, 10% of it will be deposited into a central bank. So meaning that if this bank declare bankrupt, okay, so at least you have 10 bucks. Okay, otherwise it will directly you will directly lost all of your money. Okay, so that is the required reserve ratio. Okay, and then we have excess reserve. Okay, excess reserve, additional reserve held by the bank to meet its customers' request for withdrawals. Okay, so excess reserve is just an initiative. Okay, it's an initiative by the bank itself. It's not mandatory, but it's more on the uh, their own responsibility. Okay, to ensure that the depositors money, okay, is available, is covered, okay, if they want to make any withdrawals or if any bad thing happen, Okay, so uh, if the bank's business is to lend out money, right? Lend out loan, okay? So if they lend out all money, okay, all the depositors' monies, okay, so they have no money, okay? Once the depositors make a withdrawal, so the banks may have no money to to give back the money to the depositors. Okay, so that's why as an initiative, they will keep certain percentage, okay, as their own effort, okay, in order to ensure they have money to entertain the depositors. Okay, so uh, required reserve plus excess reserve, okay, we call it as a total reserve, or if someone say reserve, it basically reflects required and excess reserve. Okay, reserve also do not pay interest. Yes, required reserve, no interest are paid. Okay, and then for the excess reserve, okay, for the excess reserve, it is considered new. Okay, previously, excess reserve is not paid any kind of interest, but after the global financial crisis somewhere in 2008, 2009, okay, uh, there is a initiative by the central bank. Okay, central bank will pay interest, okay, on reserve, okay, on the excess reserve. So basically this will actually encourage, okay, banks to keep more excess reserve in order to meet any kind of emergency. Okay, so now this action puts the bankers, okay, in a dilemma, okay, whether they want to lend out the money or to keep it as an excess reserve. Okay, they lend out the money, okay, of course they also gain return, okay, in terms of the interest rate on the loans they make, okay, they lend out, okay, and then if they keep those money as excess reserve, they also earn return as interest on reserve. Okay, so uh, the banking sector will have to make a decision, okay, whether to lend out the money or to keep. And of course, the decision is made, okay, by the difference between the interest rates they are earned by keeping the money as an excess reserve, and the interest rate that they're going to impose for those loans that they lend loan. Okay, so that is the about reserve. Securities, okay, the second items, okay, under asset is the securities. So securities meanings that is a asset, okay, asset by the banking sector. Okay, so securities when the bank, okay, uh, buy, they're converting their asset into uh, non-monetary asset. Okay, they are buying securities. Okay, like treasure bill. Okay, of course, when you're buying those securities, treasure bills, so it is an asset. Okay, so okay, so they can always convert this. Okay, in order to have liquid. Okay, Okay, so this also a good investment. Okay, uh, because it is from the government. Okay, so governments when they issue any securities is like hot cakes. Okay, because it's granted, okay, by the government, by the monetary authorities. Then the third one, okay, the third items under asset is a loan. Okay, when the banking sector lend out loan to the public, okay, to the individual, to the firms, companies, okay. Bank make their profits primarily by issuing loans. Okay, so this is the profit, okay, is a difference in terms of interest rate. Okay, they may earns from the interest on reserve and also uh, uh, and interest rates that impose on the loans that they lend out. Okay, so these are basically the main business of the bank and the commodity. Okay, and then the uh, commodity means that the goods, okay, for this banking sector is the money. Okay, the money that we deposit. Okay, okay, these are the types of loans. Okay, real estate loans. Okay, when we buying a house, so we call it also as a mortgage. So basically, the global financial crisis, okay, in 2008, 2009, it was a failure of this mortgage. Okay, so when the NPL, okay, is very high, the non-performing loan. So meanings that the people that having loan, okay, actually fail to serve their debts. Okay, fail to serve their debt. So because at that moment, okay, what I've been doing by US, okay, this global financial crisis, uh, the epic center is coming from US. Okay, it is because US apply what we call it overconsumption model. Okay, overconsumption model. When we apply loan, okay, there is certain rules or kind of prerequisite requirement. Okay, prerequisite requirement. Actually, they're gonna make a simple analysis about your credit rating. Okay, so Okay, so means that during the global financial crisis, the US they are having a losing, okay, the rules. So more peoples are not eligible for the loans can have the loan. Okay, so that's why the non-performing loan is very high. Okay, other asset, okay, physical asset, okay, the equipments. Maybe bank also may have land, buildings, okay, as their capital. Okay, we have reserve, securities, loans. Okay, so that are the three main items. And then cash item in the process of collection. Okay, so these are the process in order to cash the check. Okay, when the check is floating. Okay, if you deposit your check, okay, today before 11, okay, so your check will be processed at least 2 to 3 days. Okay, it based on whether the check that you issue is coming you issue, and the ones that are going to cash the check into their bank is the same bank or a different bank. Okay, you can issue a check from bank A, and then someone else can cash the check into bank B. Okay, you can do it, but it may take a longer time. Okay, it may take longer time. Okay, so when it is floating, okay, it's not clear. Okay, sometimes today we have an online system. Okay, if you bank in any check, okay, while it is still in terms of floating to cash, okay, it's already appear. If you cash the check, it's already appear the amount in your account. Okay, but if you try to withdraw, you cannot. Okay, so it's still in the floating process. Deposit at other banks. Okay, so bank also have a deposit into another bank, especially those small means that in terms of the financial institutions. Okay, not to compare with individual basis. Okay, so they will also have a deposit. Okay, at larger banks. Okay, so the importance. Okay, the important items is the loan, securities, reserve. Okay, these are the three main important items under the asset uh, side. Okay. Next is the liabilities. Okay, so the major items on the liability side is a deposit. Okay, all type of deposits. Okay, saving deposit, demand deposit. Okay, when the depositors park their money into the bank. Non-transaction deposit. Owner cannot write check on non-transaction deposit. Okay, so you cannot write a check. Okay, so it's not a checkable deposit, or also called known as a demand deposit. So saving deposit, you are not allowed to write check. Okay, if you want to use a check, you need to open the checkable deposit. Okay, so and then liabilities. Okay, liabilities when the banks borrowing from others. Okay, they are borrowing from the central bank, they are borrow from other banks, or they are borrowing from the others private firms. Okay, under the repurchase agreements. Okay, so if they are borrowing from the central bank, the interest rate imposed by the central bank called as a discount rate. If they are borrowing from the other banks, okay, the other bank also impose interest rate, so the interest rate is a federal fund interest rate. And then the third one, they are borrowing from the private sector, huge corporation, firms, okay, or companies. So capital, as mentioned earlier, is very important for the banks. Okay, insolvent, okay, bankrupt, insolvency, having liability in excess of asset. Okay, so this is not the case for the bank, but also for us individually. Okay, so we need to have our asset greater than the liabilities. Okay, because we are not sure, okay, what will be happen in the future. So if you have more liabilities, okay, everything that you buy and using loan. Okay, everything you buy using loan, so you have a lot of commitment, a lot of liabilities. Okay, so any failure, you're gonna lose everything. Okay, so it will be better to buy something small, but you have the ownership, okay, rather than you buy something big, but it is your liabilities. Okay, okay, then is the asset transformation. Asset transformation, it is where bank converting, okay, converting the liabilities, the deposit, okay, the deposit into asset. Okay, so when they receive deposit, is their liabilities, but when they are lent out, those money received from the depositors, okay, and then they are paid, okay, the installment by the borrower, right? So that is the process of converting, okay, the liabilities into asset when they are lent out the loan, and then every month the borrower pay the installment. So that is the return, okay, return, or the bank start to making profit. Okay, so these are the process, okay, of asset transformation. Okay. So we're gonna discuss, okay, a few transaction, okay, that take place based on this T account, okay, under the balance sheet, okay, between asset and liabilities, okay, because you have to be very careful, okay, because we're gonna discuss two balance sheet, okay. First one is from the banking sector, another one from the central bank, okay. So for example, okay, for the reserve, it is an asset for the banks, okay, because it's a mandatory deposit, okay, from the bank into a central bank. So the reserve is the asset for the bank, but reserve is a liabilities for the central bank because the money that been deposited, okay, deposited by the banking sector is a liabilities. The same goes the money when the public deposit money into a banking sector is a liabilities. Okay, so there are two set of balance sheets that we're going to discuss. Okay, so now we are actually focusing on this banking sector. Okay, so you need to aware about the items, okay, the different items between these two balance sheet and the position of the item, whether it is asset or liabilities. Okay, three examples of basic banking transaction. Okay, first one, cash deposit, check deposit, making a profit. Suppose a customer deposit 100 baht, okay, into his or her checking account at Maybank. Okay, so Maybank is one of the Malaysian commercial bank. Okay, so the customer deposit 100 bucks, okay, in his checking account. Okay, so 100 bucks is deposited into checking account. So 100 bucks deposit shows up a new liability. So when we say new liability on Maybank, okay, so the liability of Maybank is now increased. Okay. Okay, so the deposit increased by 100 baht, okay, under the liabilities part. Okay, so how do we contra with the asset? Because the two part, asset and liability, must be uh, balanced. Okay, must be balanced. So it will be a cross, okay, with the reserve of 100 baht. So deposit, okay, deposit that received by the banking sector will be deposited, okay, into a reserve hold by the central bank, which is mandatory. Okay, so now you can see over here all the 100% received by the central bank. Okay, sorry, all the 100% deposit received, okay, by the banking sector is now converted into reserve. Okay, just now we see that the required reserve or the excess reserve is just a certain percentage. Okay, but based on this example, 100% of the reserve is 100% of the deposit is converted into reserve. So if this is the case, meanings that the required reserve ratio is 100%. Okay, the required reserve ratio is 100%. So whatever money received by the bank must be deposited as a required reserve, okay, at the central bank. Okay, so basically, okay, we have two types of reserve. Okay, one is 100% reserve system, reserve banking system. Another one is fractional uh, banking reserve. Okay, fractional is the ones that we at the beginning we have mentioned is only a 10%. Okay, if we go for 100% reserve banking system, so all the money deposited, okay, by the public, by the depositors, will be directly transferred to the central bank as a mandatory for the required reserve. Okay, so meaning that if this is the system apply, so Maybank, okay, in this case, have no money to lend out as a loan. Okay, and one good thing for the deposit, for the depositors, they should feel secure because all the money is there. Okay, if the bank bankrupt or whenever we want to make our withdrawals, so we gonna have back our money. Okay, so that is the advantage of this 100% reserve banking system. Okay, is it clear, guys? Okay, thank you. Wow, wow, a lot of, okay. Okay, second examples, okay, when you are depositing money using check. Just now, they are depositing 100 bucks into his checking account. So they bring cash into the checking account. Okay. And next is next is to deposit using check. Okay, so a Maybank customer, okay, deposit a check of 100 bucks written on an account at Citibank. So meanings that this customer, the Maybank customer meanings that this customer have a Maybank deposit account, okay, checkable deposit account, and he or she receive a check, okay, where they're going to cash the check, okay, but the check is written on a Citibank check. So meanings that they're going to cash a check, okay, in Maybank, but using a Citibank check. It's a cross bank. Uh, it's a cross bank to cash the check. Okay, as mentioned earlier. So meanings that this process may take a longer time. Okay, longer time meanings that maybe 2 to 3 days. Okay. Okay, so once the check is deposited, okay, in this Maybank account, so yes, the liabilities increase, okay, but it is not directly contra, okay, with the reserve. Okay, so we have the floating process. Okay, thing process. So it will go cash item in a process of collection. Okay, cash item in the process of collection, and then when it is clear, then in my bank it transfer to reserve. Okay, again, if this is the transaction recorded, so they are applying 100% uh, reserve requirement banking system. Okay, that is for my bank. Okay, since the money is coming from Citibank, so we need to look also what happened to the Citibank. So Citibank liabilities, okay, is decreased by 100 baht, okay, because the 100 baht is now transferred to the Maybank. Okay, of course, by withdrawing this 100 baht, so it will also decrease the reserve, okay, from this Citibank asset. Okay, it's a reduction, okay, for the Citibank for the both asset and liabilities of 100 baht, but it is a increase or additional of 100 bucks for both asset and liabilities of Maybank. Okay. Is it okay to go for more? We finish until these two more slide. Okay, we finish this deposit issues. Okay. So next, the last. Okay, the third example. Consider Maybank situation after it received 100 bucks in checkable deposit. Maybank must hold 10% or 10 bucks as a required reserve, and the remaining is 90 bucks as an excess reserve. Okay, so now they are not apply the 100% reserve banking system. They are applying the fractional, okay, fractional reserve banking system. So required reserve 10%, okay, they receive 100 bucks as a deposit, which is under the liabilities. So this 100 bucks must be contra with their asset item. So it's be contra with the reserve, but it's not 100% on the required reserve, but the rest is kept by the bank, by the Maybank, as a excess reserve. Okay, so meanings that the earlier example, okay, example one, no loans. Okay, the Maybank are not making any loans. They are not lending out the money. Okay, as all are, they are applying the 100% reserve banking system. And the third example, they are not applying 100% reserve banking system, but they are applying the fractional reserve banking system, but they keep the rest as an excess reserve. Okay, so again, okay, the bank are not lend out any money as a loan. Okay, okay, so now, okay, instead of keep the rest of 90%, the 90 bucks, okay, as an excess reserve, okay, the bank can also make a decision because the excess reserve is an initiative by the bank itself. Okay, so they have the full power, okay, full authority to make up their mind whether to keep the money as a precautionary purpose or to lend it out as a loan in order to make profit. Okay, so this time around, they're going to lend out this remaining of 90%. Okay, so they go for loan. Okay, so basically more loan is make, okay, required reserve 10 bucks. So both asset and liabilities still balance. Okay, still balance. Okay, so simple example over here. If they lend out the loans, okay, by imposing 10% interest rate on the loan, so basically they're going to earn 9 buck, okay. And Maybank pays only 5% on checking account balance, okay, it costs. Okay, they also usually checking account, okay, checking account is not paid any interest, any return, okay, usually, okay, but maybe we can just for the purpose of simulation, okay. Sometimes saving deposit they are paid but very low. Why they are paying very low interest on the saving deposit? Because we can withdraw at any time unless you go for the fixed saving deposit. So you are not allowed to withdraw, okay. In the same times, banks are available, okay, they are available with the money in order to make loan or any business with your money. Okay, for example, you fix up 3 years fixed saving deposit. So for the 3 years, you cannot withdraw the money. If you withdraw the money, you are breaching the contract instead of losing whatever return, expected return or whatever promising return. You will be also penalized by the banks. Okay, so be careful. Okay, because the rate of interest they're going to pay for the fixed saving deposit is higher. Okay, but the ones that we have, the ATM, the saving deposit that we have, they're going to pay very small interest unless you have a huge amount of money, 100k, maybe you will feel, okay, some little tiny return. Okay, so in this case the return, okay, is 5% on the deposit, but when they lend out your money, they impose 10%. So they're double up. Okay, so the difference between the interest imposed on the loan and the interest as a return, okay, the 5% over here is the interest rate as a return on your deposit. The 10% that imposed on the loan is the cost of borrowing. Okay, the cost of borrowing over here going to bear by the borrower, okay, the public. So the difference between the interest rate is basically the profit, or this define the process of asset transformation. Okay, so that's it. Okay, I'm not going to continue further. Okay, going to continue next week. Inshallah, hopefully. Okay, we're gonna meet face to face. Okay, inshallah next week. Okay, so any question from our discussion? Any question? Hopefully all of you have fill out your attendance. Anyone's are still not fill out the attendance link. uh i I think we have 31 members, and you are skip 3, skip 15, 29, skips 2. We have 27. 4 more members are not here. 4 more members are not here. Are they here? Just join, or you missed the attendance link? No. Any question? Yes, Amirul. Any question? No.
No, Doctor.
Okay, so I take it as a no question. Okay. Um, Last question. Can we end the session? Okay, so the thumbs ups, I take it as a yes. So with that, thank you very much for joining the session. Okay, and assalamualaikum.
Thank you, Doctor.
Thank you, Doctor.
Thank you,
Okay.
Doctor.
Thank you, doctor.
Okay, welcome all.